from 1590 minus 1830 is $2.04. We're going to multiply that by 1,100 shares, because that's how many shares of stock I have now. That's a gain of $2,640. Now remember, I lost $400, let's say $450, just to be fair on this. So I will subtract, that's 26.40, we got to put everything in positive here. I'll subtract the $450 that I lost on my initial position, and I would have purchased I would have purchased 6 of these for approximately $600 in protection, and 5 of these for approximately $300 in protection. That's $900 in additional protection on the stock in the form of put options, leaving me with a profit of $1,290, in which the stock only rose from the $17.90 that I purchased it to $18.30. That's only 40 cents. Do you see that? I purchased the stock here. It dropped here. I cashed in my insurance policy, bought additional shares of the stock. It rose up, and now I've sold it here. For $18.30, which is only 40 cents above where I purchased it, but I made $1,290. You see how powerful this strategy is? Now, I could have sold it at that point and retained my $1,290. However, in most cases, what I'm interested in is dealing with the stock over a longer period of time. As the stock moves higher, I would now also sell my existing puts, and using some of the profits of a higher position in the stock, using that to purchase additional puts. Sometimes, in most of the cases, if the position starts out badly like this one did, I would use the insurance policy by cashing it in to purchase additional shares of stock every time this dropped. I could have done this a number of different times, actually. I could have purchased an insurance policy here by buying the puts, have it run up, sold the puts I had here to buy additional puts here, let the stock run down, cash in my insurance policy, buy another 40-50 shares of stock, buy some additional put options, let the stock run up, purchase additional put options if the stock fell down again, and so forth, all the way up until I reached a higher level. However, in many cases in which the stock had fallen dramatically and you purchased additional shares of stock at a lower level, a lot of times what I'll do is I'll feel that the stock has failed to perform, and I will wait for that additional rise in price and then cash out at a $1,290 profit, and then go look for a different stock that has greater potential on the upside. But the idea is to use your insurance policy that you purchased on the puts in order to purchase additional shares of stock at a lower level if the stock does drop. That is something that generally only professionals do, but now you have the knowledge as well on how to do this. You may have read in other investment books about dollar cost averaging. For example, let's say you were purchasing stock back here when the stock was at $26. If we go back to this level right up in here, let's say you purchased the stock here. Well, dollar cost averaging would mean that not only would you purchase a stock here, but as the stock dropped, you would purchase additional shares, and that means putting more money out of your pocket In this case, we invested $17,900 in the purchase of the stock, but we used our insurance policy to purchase additional shares of the stock when the stock dropped. We did not take any more money out of our pocket in order to purchase those additional shares or the insurance. Here, if you were to do traditional dollar cost averaging, means that you would purchase additional shares of stock out of your pocket in order to increase the number of shares that you were purchasing, but that would be a terribly really horrible plan. As the stock continued to drop, you'd continue to buy more and more shares with more money out of your pocket, which would cost you many thousands of dollars. If I was to purchase shares of the stock at $26, I had an insurance policy. Remember, I like to have it very, very tight on initiating positions. My maximum loss is only going to be between $400 and $500. At that point, I probably would have bought something like the $27, $26.50 strike price puts. And then as the stock dropped down to $22.50, I would have been able to cash in a $4,000 policy at that point, use some of that to buy some additional protection, and use the rest to buy additional shares of the stock. So that's the difference between this type of a strategy and dollar cost averaging. This is a truly dynamic way to trade because your insurance policy, the puts that you put into place when you initiate a position, allows you, if the stock does drop, to purchase additional shares of the stock. When the stock does eventually increase in price, I mean, you could have purchased insurance policies all the way down during this decline. Let's say you started with an initial position of 1,000 shares. By the time it reached $17 a share, you could have had, instead of 1,000 shares of the stock, you could have had 3,000 shares of the stock with the additional cashing in of the put options that you had as insurance. Now at 3,000 shares of the stock at $17 and it rallies up to $18.50, now you're making close to $4,500 in profits just from a small rally in the stock with no extra cash out of your pocket whatsoever. And if a strike price was not available in which you felt comfortable with your insurance position, you could have created, as I mentioned here, a synthetic strike price by splitting the number of put options that you were going to purchase on the way down. This is truly a dynamic way to generate spectacular returns in the market. And it's actually a way for you to increase dramatically the amount of profits that you'd be able to create. Let's take a look at Cisco for a second. I mean, imagining purchasing the stock for Cisco up $29 back here in the beginning of 2004, only to see the stock dramatically decrease in price down to $16.50. Without insurance, you would have lost approximately $12.50 a share. But with insurance, you could have cashed in those policies every time it went through your strike price before expiration, cash in those policies, purchase new puts, and all the while using your put insurance to accumulate additional shares of the stock. Then once it gets down to this point here, you would have had maybe started out with 1,000 shares of stock. By the time it reached this point, you would have had maybe 2,000 shares of stock, and then seen a dramatic rise in price all the way back up to $29. Your insurance would have actually helped you accumulate additional shares. At $17 to $29, that's a $12 increase in price. On 2,000 shares of stock, that's approximately $24,000 in profits. And your initial cost was only $29,000 for the initial 1,000 shares of the stock here. You see how powerful that is? And you would have gotten to the point where, I mean, the stock was at the exact same level that you purchased it, back here in the beginning of 2004, and then 2007 you're back up to $29, but instead of you would have made a $24,000 profit on your $29,000 investment. Yeah, it would have taken you a couple years to get back up to that level. But if you just purchased 29,000 shares of stock without any type of protection, without any put protection whatsoever, no insurance policy on the stock at all, you would have seen only a break even on this position.